you're watching Business World Live. I'm Danie Laurel. It's the start of a new trading day, but first let's go straight to our top story. BSP Governor Ben Diokno believes the worst is over for the Philippine economy and is optimistic about a remarkable rebound this 2021. Speaking at a Reuters forum, Diokno said the recovery phase has begun, citing improvements in remittances and foreign direct investments. Diokno also said the current monetary policy is sufficient for a growth revival. That's after the economy slipped into a recession for the first time in nearly 30 years last year. Speaking of recovery, Moody's expects the country to grow by 7% this year. That's well within the target range of 6.5% to 7.5% given by the government. Moody said the GDP may have contracted by 8.7% in the full year 2020. Moody's senior vice president for Sovereign Risk Group said pandemic-related restrictions may prevent the Philippines as well as India, Hong Kong, and Singapore from recovering to 2019 output levels. Meanwhile, Finance Chief Sonny Dominguez is throwing his weight behind proposals to amend so-called restrictive economic provisions of the 1987 Constitution. Dominguez said he supports the further opening of the economy to foreign investors, especially retail trade and construction industries. The House Committee on Constitutional Amendments will open deliberations on talks of the Economic Chapter today. Okay, let's kick off the markets report with a quick check on where we stand when it comes to the COVID-19 saga, the never-ending saga, and those never-ending figures. You can see on my terminal here the net change, so that's the new added cases as of the last day of reporting. You have 650,000 new cases worldwide, whereas in the Philippines, you've got 1,522 new cases. Now, this figure comes amid more reports of the new strain that are now appearing in other countries. The Philippines expanding its travel ban to 5 other countries. So these are now China, Pakistan, Jamaica, Luxembourg, and Oman. We were already at 28. Add to that, the 5 travelers will not be allowed entry into the country effective of noon today. And so far, the ban is just until Jan 15, but is still subject to recommendation. We are still awaiting, of course, for developments on the vaccine front. We've got the vaccine supply deal seen to be signed this week. Recall our plan is 148 million vaccine doses this year. Now, of course, the shutdowns, not a good sign for tourism, adding to the woes. This from the Philippine Star. You've actually got inbound tourism receipts dropping a whopping 83% last year. This was reported by the Department of Tourism yesterday. Tourism Secretary Berna Romulo Puyat said that the receipts generated from the tourists inbound was 81.40 billion pesos. Now, this is a sharp decline from 482 billion pesos in 2019 versus the original target that was set pre-pandemic, of course, of 661 billion pesos of receipts for last year. Now, when it comes to visitor arrivals, same story there. Foreign visitor arrivals declining 84%, so 1.3 million tourists in 2020. That's from 8.2 million, so 1.3 versus 8.2 from 2019, and also versus the target, which was 9.2 million. So what are they going to be doing? Recalibration of targets and refocusing towards domestic tourism, at least in the short term. That's according to Secretary Puyat. Now, of course, one major industry in focus today will be the airlines, how they will be faring, especially with that added ban, which, is already adding to their woes, and plus this report, of course, of tourism still on the downward path. You can see that on my terminal here. Airlines not doing too well at the open. Now, unsurprisingly, they're still in focus, not in a positive way, and this according to a think tank, which is the Center for Asia Pacific Aviation. Airlines are expected to be, quote, close to catastrophic, at least for the first half of the year. But they are saying maybe they will see improvements in the second half of the year. They are expecting at least business travel to be as much as 50% of the previous level. So let's take a step back and take a quick peek at global equities. Now, you've actually got Asia seeing quite a muted start to trade. This is, of course, today with Japan having opened lower together with Australian shares. It's lower in early trading. This, of course, happening as the US 10-year Treasury yields fell to just above 1.1%. Now, the spread between the 2-year and 10-year has actually risen every day, at least since the start of 2021. Investors seem to be betting on additional US stimulus. You can see on my terminal here a bit of a mixed picture with Japan, as I mentioned, in the red, but you've got South Korea actually in the green this morning together with Singapore. Now, elsewhere, I just want to touch on Bitcoin. That fluctuated around the $34,000 level, gold extending gains, and crude oil is now at an 11-month high. Now, I just want to take a quick peek at our open here, whether we are following suit with the developments that we've seen in other areas, at least in Asia. Doesn't seem to be the case. Opening on the back foot here, down by 0.12%, 7249.12. Now, to talk about these developments on the markets and more, we have with us Rastine Mercado of Chinabank Securities. Good morning, Rastine, and welcome to the broadcast.
Hi, good morning, Danie.
Rastine, let's kick off on a broader base here, and what indicators you're looking at when it comes from a global perspective to show that there might be some hope on the horizon. It seems that the U.S. yields, are now inching its way lower. The spread has still nevertheless been widening since the start of the year, but that might also be a positive thing because of the stimulus here. Oil prices, at least the WTI, hovering above 50. Does this in any way signal a sign for better times?
Well, if your yield spreads are rising in the U.S., right, they're becoming much wider. There are expectations now, and we've seen pronouncements from the Fed that indicate that there might be a strong economic recovery towards the latter half of 2021. So, what does this mean? So, as of now, the Fed is buying bonds. It's also pretty loose in terms of monetary policy. So as we know, if unemployment rates go significantly lower over the next 12 months and inflation rises in the U.S., then the possibility of rolling back these dovish policy measures in the U.S. is a possibility. So some Fed officials have already indicated that that might be in the horizon. So I guess that's what's driving yields to make the spreads wider, right? So for the local market, will still be very dependent on developments on the vaccine and the pandemic. So hopefully we don't see that uptick that other countries are seeing. As of now, we still don't have that more infectious strain in the country. So for so long as that the number of cases is kept at bay, then I think that our prospects of recovery this year remain strong.
Okay, so we'll get back to you on the vaccine strain and the new strain there. But let's talk about the yields just for a few minutes here. What does
Sure.
that mean for our own for foreign investors coming into the Philippines, given that our own yields or interest rates are at an all-time low? Of course, the governor has said that it might stand pat at least for the rest of the year. And if the U.S. starts to see a recovery and possibly starts hiking rates, what would that mean for us?
Well, that would mean that we may follow suit in terms of our own policy. But then again, there are a lot of different factors now that would affect that decision. So as of now, the view is that policy rates will stand pat. But then obviously, policy will be driven by inflation and unemployment. So any sustained increase in inflation, like spiking above the target, might be a possible catalyst for future rate hikes. So obviously that risk remains low at this point. But then again, if the economy continues to recover, then that's a natural occurrence that comes, right? So hopefully we do see that economic recovery coming into fruition this year.
You've also got Bedyokno having some comments here saying that we will see a spectacular rebound in
Mm.
2021, and this comes after at least a reaffirmation from Fitch and Moody's as well that it might not be as bad as they had hoped, as not hoped as they had expected from last year at least. To what extent is this reliant on just the vaccine, and to what extent is it because of the fact that we are really seeing some sectors improving when it comes to output, when it comes to consumption spending, and the real economy really improving?
Well, on one facet, right, your consumer and business confidence indices have recovered since the lows in the first quarter, second quarter. So I think that's good because consumer private demand will should underpin the recovery in the economy this year. In terms of growth, yes, we do expect strong growth at least for the first half. That's much more pronounced. That's because of the low base effect from last year, right? So in terms of your restrictions, your quarantine restrictions, those have been progressively scaled back, right? So that should improve mobility. That should continue to improve mobility across businesses and as well as consumers, right? So hopefully we see that progressing in much more full swing in terms of rolling that back. It's really uh, it's really shoring up consumer confidence and comfort in engaging in their usual economies pre-pandemic in towards the end of this year or hopefully earlier. That's what really needs to happen actually for for the economy to to recover much faster.
Can we reach these growth levels? Moody's now saying 7% for the year. Of course, it's still much lower than how we've contracted in 2020. But can we achieve that with all of these tourism bans and with tourism still possibly dropping the same amount and just relying on our own domestic tourism, our own domestic resources?
Yeah, I think so. Our economy is broadly based on consumerism, private consumption here, right? So, in terms of getting people domestic travel, I think that's one facet where where the travel industry, can see some growth year in year. So, I think that in terms of that, we're in a pretty sweet spot. With again, I mentioned consumer confidence recovering. So hopefully that does translate into better consumption through the year.
Okay, and just a look at the index levels here. What has the rally over in Wall Street already spilled over? Did we actually feel the rally because of the Biden win and the increased stimulus? And to what extent does that actually have a direct impact on our stocks? And to what extent are you expecting a pullback now that that seems to be already set in stone?
Well, a lot of the rise in the market has been seen in the fourth quarter of last year, right? So that came on the heels of vaccine developments. You had Moderna and Pfizer come out with their vaccines. So I think that really buoyed investor optimism. In terms of foreign fund flows buoying markets, they've actually been net sellers, pretty consistent over the past few weeks. So I think in terms of sentiment, we're with them. But then we see that kind of stalling. Last Monday, we did see a one-day reversal on the market. The market tried to break out, but then selling pressure remains strong. So that's why there's slight bearish bias over the next few days. Hopefully, we do sustain that momentum. But then again, at this point, we have high expectations that have to be delivered upon. And also, you have these new policies or prospects in the US where the new administration is seen to inject additional stimulus into the economy, right? So those expectations may already be largely priced in. So in terms of forward catalysts to fuel the market rise, what else is there? So I think it's a healthy development in any sustained uptrend that we consolidate or pull back. If we do, around 6-8 might be a good place to look at in terms of starting to buy or accumulate, and 7-5 remains our main resistance.
Okay, so thank you for those insights. 8, nice time to be buying back in the markets. But of course, as you mentioned, still some room to run there, at least for our local index. Thank you for those insights. That was Rastine Mercado, Chinabank Securities. Checking in on the headlines, we're keeping our eyes on cold chain is expected to become a 20 billion peso industry by 2023 with fresh impetus from vaccine storage and distribution needs. BOI managing head Seferino Rodolfo says they are expecting the vaccines to arrive in the country soon. That's with emergency approvals expediting the procurement process. Thus, the cold chain industry is prepping for the nationwide distribution of such shots, which require certain temperatures. Now, despite this fresh boost in demand, Cold Chain Association of the Philippines President Anthony Dizon says the growth of the industry will still largely depend on their core business, which is food production. Still, he says the industry is just waiting for more information from the government on the vaccine procurement so it can make sure that supply chain facilities are available to complete the distribution cycle. The Duterte administration recorded its slowest spending growth in 2020, that's at the height of the coronavirus pandemic. You can see on your screens here the deficit stood at 1.36 trillion last year. That's widening from over 660 billion in 2019. Now, at that level, the budget gap was estimated to account for more than 7% of GDP. Expenditures went up almost 11% year on year, while revenues sagged 9.4%. Despite the record high deficit, Finance Secretary Sonny Dominguez welcomed last year's fiscal performance. That's on the back of Fitch Ratings affirming the Philippines' BBB rating. And that's a first look into the business day. Today is Wednesday, January 13, 2021. Catch Business World live for the market close. It's at 3:15 p.m. today. I'm Danie Laurel, and we are One News.